The asset class this year has been commodities. And guess what? Commodities were doing amazingly well in 2000 when the market was falling, and commodities were doing amazingly well in 2008 when the market was falling. And then something changed, and it wasn't good for anyone. Stick around, I'm going to tell you exactly what's going on. Hey everybody, RC Peck here. This is my weekly video. I spend a lot of time thinking about what to talk about. Obviously, I'm not going to talk about what's on TV or CNBC or Bloomberg or Fox because you don't need more of the same information. I want to see what maybe people aren't seeing. And this is whether you're in the stock market or the bond market or the stock market. I said stock market, commodity market, whether you're over 50, under 50. This matters because here's what I've noticed about humans. Collectively, we do not change. Yes, someone will lose 50 pounds, someone will gain 20 pounds of muscle mass, someone will change their behaviors, but collectively, we do not change. So going back in history and looking at price charts and seeing how we reacted and acted during other corrections is really important. So we're going to do two main things today. We're going to look at the 2000 stock market fall, and we'll look at the 2008 stock market fall, and we're going to compare those two with what's happening today. So let's do this. Let's get into it. Let me bring over the price chart. And the first price chart I want to show you is there's actually two pieces of data on here. We're looking at 30 years of data. The top price chart is the S&P 500. I'm using SPY. It's an ETF. That price chart includes dividends reinvested. And what I'm doing is I have sectioned off or put in these yellow sections for the 2000 where the S&P fell 50%, in 2008 where it fell 58%, and today the S&P is down 20%. And then in the bottom chart, I have the CRB index, that's the commodity index, and I have the same kind of periods marked off. So I want to show you and talk about what happened in 2000 and 2008 and 2022 today, and talk about why you probably don't want commodities falling. So on the screen here is let's start with the 2000. This is the 2000 market fall. The top price chart is the S&P. It fell, you can see that there. It fell, well, you can't see the percentage, but it fell 50%. And it took its time. It really took its time. 30 months to fall 50%. 30 months, that's 2.5 years. Look at the bottom price chart. The bottom price chart is the commodity index. So for the first, let's keep it really simple. For the first third of the stock market fall, commodities went up. The middle third, commodities fell. Not badly, they fell about 20%, so that's not a big deal. And then after they fell 20%, they started rising again, right back up to where they were when they started falling. So in 2000, you did have commodities bucking the trend while the S&P fell 50%. Now that was just the S&P. You had other index fall 60, 70, 80%. I'm just looking at the S&P right now. So I kind of think of the first 6 months of what's going on right now in 2022 as the beginning of 2000, where commodities went up and then they stopped. And it may not be as obvious with the S&P during the 2000 fall crash drawdown, but things got way, way more volatile after commodities were falling. You saw the market start to fall at a much steeper rate, correct, get back, fall at a much steeper rate again, get itself back, fall at a steeper rate. So volatility went up. The market continued to go down as commodities were falling. And so that's one of my fears today, that commodities, if they have stopped going up, at least for right now, maybe not forever, because remember in the 2000s, commodities were the asset class to be in, but that doesn't mean they're going up every day, week, month, quarter, or year. So 2000 is saying, hey, be careful. If commodities start falling, that could have us see an acceleration of 2000, like 2000. And then here is the price chart of 2008. Similar and dissimilar. So in 2008, the S&P fell 58%. The first half of that fall, not in percentage terms, but in time, right? So that fall took 18 months for the market, for the S&P to fall 18%. In the first 9 months, commodities were the place to be, and then they absolutely cratered. And guess what happened? The stock market became much more violent. It had a much farther downside. The volatility, the price violence absolutely exponentially went up. In fact, kind of the decline of the S&P before commodities started falling was actually quite calm. Like, yes, it was falling, but it was just very calm, not much to kind of report. And then we have today, and let me zoom in on today. Let me just get a zoom in for today. And so here you have 2022 where the S&P is down about 20%, the Nasdaq's down about 27%. And as you can see, during that same time period, commodities have gone up until, just easy math, call it the beginning of June. And since the beginning of June, they have started falling. Now, they're still positive for the year. They're still trouncing every other asset class, almost every other sector, almost anything this year in 2022. Nothing has beaten what commodities have done. But my concern is that if commodities turn sour, copper's dropping off a cliff, wheat is, oil, energy, almost name the commodity, and it is down over the last month. My worry is that we go into kind of a 2000 scenario where that just accelerates the stock market lower, or a 2008 accelerates it lower. The S&P fell 50% in 2000 and fell 58% in 2008. And both of those times, it was very orderly fall at the beginning, right? The market was just down. It was kind of just slowly moving down. No trauma, no drama, down 20, 22, 25%. And that's kind of what we're doing now. And so my concern is that there's a chance, because of how weak and bad commodities are looking, that we have a chance of starting to accelerate this downfall. Now, you've heard me talk over many of these videos where during these periods, people feel like they've got to do something. Now, I agree they have to do something if they have not stepped out of the market, or they don't have a strategy that steps out of the market. I do. That's how I manage money. It's 4 steps out and 4 steps in. And we literally look to the market to see whether we should be stepping out or stepping back in. The point is, during these periods of instability, which we started at the beginning of the year, the job is to keep your money safe. That doesn't mean have it in bonds. Bonds are down 10 to 12% or more this year, depending on what type of bonds you're in. So it's not like, oh, have my money in bonds. It's about putting your money in the safest place until we're through this instability period. And we are 7 months into this instability period. Notice I'm using instability, not bear or bull or overbought or risk on, risk off, or any of that verbiage that comes out of the 1970s Wall Street that still big box advisors, financial advisors, money managers still use today. This is about being smart, protecting your money during periods of instability. We are 7 months in a period of instability. In 2008, it lasted 18 months. In 2000, it lasted 30 months. In 1974, it lasted 18 months. Of course, it doesn't have to last that same amount this time. That is what has been happening, or has happened the last time the market was behaving exactly like it's happening today. Let me know where you think I got it right, where I got it wrong, what I missed, what I didn't talk about. I'm not going to talk about crypto and real estate each time, so please don't say talk about crypto and real estate. I got it. I'll do it every once in a while. But what did I miss? What did you like? What did you not like? Leave a comment. I will absolutely answer it. And look, if you are worried or concerned about what is going on with your own portfolio, you may want to just reach out to us. It's super simple to do that. You can just look in the description below, and literally what we'll show you on that almost initial phone call is like, look, you're probably over diversified. You're probably underperforming the unbeatable index, and you are probably rebalancing your portfolio based on very outdated beliefs. Thanks, guys, for being in my world. I appreciate you, and I will see you on the next video. Okay, bye.